Hey everyone, welcome back to Corporate Decoder. Today we are diving into a report from a company that's making some big moves with its debt. It's like they're playing a high stakes game of financial twister, so let's see if they can keep their balance. This report is all about how C&F Financial Corporation is dealing with its debt, raising new funds and paying off old ones. We will break it down to what it means for the company and if this is a good move on their end. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, so join us there if you want to chat more about this and other companies we cover. Alright, this is a Form 8K filing which companies use to announce major events. This report is a snapshot of a significant financial transaction that happened on June 6, 2025. C&F Financial Corporation, based in Virginia, is the company we are looking at today. They are trading under the ticker CFI. The main event here is that C&F Financial Corporation entered into an agreement to sell new debt. They are calling it a subordinated note purchase agreement. Basically, they are borrowing $40 million by issuing notes, which are like IOUs, promising to pay back the money with interest. These notes are called 750% fixed to floating rate subordinated notes due 2035. That sounds complicated, but let's break it down. The company needs money and is selling what is called a note to get the money. Think of it like a fancy IOU saying they owe the person who bought the note plus interest by 2035. These notes have a few key features. For the first few years until June 2030, the interest rate is fixed at 750% per year, paid twice a year. After that, the interest rate changes based on something called the 3-month SOFR rate, which is a benchmark interest rate plus an extra 3.885%. This means the interest they pay can go up or down based on market conditions. The agreement also includes standard promises and guarantees between C&F Financial and the people who are buying the notes. If C&F Financial runs into serious financial trouble like bankruptcy, they have to pay back the notes immediately. These notes are subordinated, meaning that if the company goes bankrupt, other lenders get paid back before the note holders do. This makes these notes riskier than normal loans. The people who have the notes can't turn them into stocks. Only C&F Financial can choose to pay off the notes early. Starting June 30, 2030. The company structured these notes so they can count as Tier 2 capital. This is a regulatory term for bank holding companies. Tier 2 capital can be used to support their operations and growth. The company says they will use the money from selling these notes to pay off some existing debt and for general business purposes, including future growth. This part just confirms that the new debt obligation we talked about is in fact happening. Along with issuing the new notes, C&F Financial used some of the money to buy back its old notes, the 2030 notes. They bought them back for the full amount plus any interest they owed up to that point. Finally, this section lists the legal documents related to the note sale, which are included as exhibits. This includes the subordinated note purchase agreement and the form of the subordinated note. So what does this all mean? C&F Financial is essentially refinancing its debt. They're taking on $40 million in new debt to pay off $20 million in old debt. They are hoping that by extending the time they have to pay back the money and using the extra cash for growth, they can improve their financial situation. But they're also taking on risk with that floating interest rate, which can become costly if rates keep going up. So now let's dive a bit deeper with my own analysis. I think C&F Financial is trying to position itself for future growth. By freeing up some capital, they are betting that the investments they make with the extra cash will generate enough profit to cover the higher interest payments and then some. It's a calculated risk, but it could pay off if they can execute their growth strategy effectively. The risk is that the SFR keeps increasing, which would make this loan more expensive. Overall, this looks like a well thought out move by C&F Financial. They are managing their debt responsibly and positioning themselves for future growth. But like any financial decision, it comes with risks and it will be interesting to see how it plays out in the coming years. Alright, that's our breakdown of C&F Financial's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.